Hey everyone, it's Wolfgang. I wanted to do a follow-up to my video from 2 days ago on Friday, February 21st. That video is economic update and private credit market returns. There's higher returns to be had described in that video from 2 days ago and in this. This is a related sort of situation to what I talked about in that video. ECON update and private credit market returns. So this is about BDCs. Business development companies. So if you remember, I discussed the private credit market investments. So interest rates right now are right around 4.5% yield annual return. For the U.S. Treasury 10-year, the 10-year Treasury, which is what all mortgages tend to be based on, is trading now for around 4.5%. And as I mentioned in this video from 2 days ago, higher returns are available. So the cool thing about BDCs is they're regulated and you do not need to be an accredited investor. In this video, I pointed out that for a lot of these investments, you needed to be an accredited investor. For these business development companies, they're open to the public. They're regulated by the SEC. And so I'll go into all of this, but I wanted to mention this because they're similar in what they invest in. It's just that they're investable by the general public. So business development companies invest in the same market as the private credit companies that I talked about in that video from 2 days ago. They're SEC regulated, so they generally tend to invest in mid-market private companies. These are companies that are not publicly traded. And those companies, as I mentioned in this video, after the 2008 and 9 market crash, there was sort of a clamp down on bank lending. It became harder for private businesses to get bank loans, and the private credit market sort of started to grow because of that. So this is the public version of that sort of investment. These BDCs, these business development companies, invest in private businesses that have a market valuation of 250 million or less. So that's micro cap. It's really small compared to Wall Street firms, right? There's some Wall Street publicly traded companies that trade on the stock exchanges that are worth $1 trillion. So this is 250 million. This is relatively small. However, these companies are too big to get loans from the regulated banks, the post-2008-9 regulated banks. So there was an opportunity to form these business development companies to provide loans to these companies. And so these BDCs invest in the debt. In other words, they lend to these companies. Now, the structure of these BDCs is regulated. This is by law. The 250 million maximum is a regulation. They cannot invest in anything worth more than 250 million. So the returns are higher. The debt is a little more risky. The companies are smaller. They're not public companies. They're private businesses. But this is a really cool way to improve your return, potentially, if you're willing to take on a little more risk. By the way, I want to point out that this is not investment advice. Before you invest in anything, you should consult with your investment professional, your tax guy, and so on. I'm just bringing these up because this is related to my video from a couple days ago that required accredited investors. These BDCs are for the general public. They're similar to a venture capital or private equity fund, but they're open to the public. So venture capital, private equity funds, you have to be an accredited investor to invest in those. And if you remember when I mentioned accredited investor in this video, I said you've got to earn at least $200,000 a year or $300,000 if you're married, or have a net worth of $1 million, not including your private residence, or be a financial, be employed in the financial services industry, sort of be an expert in investing. But with these things, it's really cool. You can get a higher return, and the general public can invest in these. So BDCs were created by Congress in the year 1980. They've been around for a while. They're subjected to periodic SEC, Securities and Exchange Commission, reviews, just like mutual funds. And they, like the companies I talked about here, these guys invest in private credit. They lend to small companies. So here's the thing about how these investments work. If you, and I'll give you a list of some of the companies that offer these. If you were to invest in one of these business development companies with the intention of getting a higher return than you can get from, say, U.S. Treasuries, 90% of their income is a pass-through to investors. So it's sort of like, similar to an S Corp. An S Corporation, also a pass-through entity. Business development companies are not taxed at the corporate level. They pass through all their returns to the investors. So investors have to pay tax on ordinary income and any capital gains that they receive that get passed through to them by their investment in these BDCs. So if you watch this video, you're going to see that these are very similar. They invest in the same private credit market, or very similar companies to what the more limited investment option private credit investors that I talked about in this video. And so here's some of the companies that offer these investments. Apollo, Main Street Capital, and these are traded on the stock exchange. If you look up these names, if you go to your online broker and look up these names, you can find Apollo Business Development Company, Main Street Capital Business Development Company, FSKKR, that's Kohlberg, Kravis, and Roberts, obviously. FSKKR Capital, BlackRock, huge company. Kelso Capital has a product like this too. These are traded on the exchanges, on the public exchanges. Now, that being said, there are private versions that are not publicly traded of these business development companies. I'm not really talking about those. Those are private, they're closed-end funds, and they're not traded on the public markets. But these are traded like mutual funds on the public exchanges. They're subjected to periodic SEC reviews, and they invest in the same private credit lending markets, private debt markets, that like the companies I talked about in that video from 2 days ago. So if you have any questions about these, I wanted to cover this because what I mentioned in the video from 2 days ago was that you had to be an accredited investor, and I realized, wait a minute, business development companies, they sort of invest in a very similar market. They invest in private debt to companies who cannot get bank loans. I better cover that. It's related, and just for the sake of sort of being a very similar investment, higher return, slightly more risk, but regulated and open to the public. You don't need to be an accredited investor. So if you have any questions about these, you can post them in the comments. I'd be happy to answer any questions you have. And again, this is not investment advice. You really want to do your own homework, check with your investment professional, your accountant, before you make any investments. But if you like the idea of, some of us like to invest in debt, right? Because it's the same with corporate bonds, U.S. Treasuries, because it's a stream of income that's pretty low risk compared to the stock market. Because if you invest a portion of your portfolio in stocks, as we all know, you can see your stocks get cut in half in a single day's trading. Whereas if you're investing in loans, in debt, like U.S. Treasuries, that's debt. You're lending money to the U.S. government. They're not quite as volatile. The volatility is different compared to the stocks, to publicly traded stocks on the stock exchange. So it's kind of cool to invest in some debt. And this is just another type of debt. There's high yield junk bond debt. There's corporate bond debt. There's these business development companies that invest in these smaller privately held businesses. There are U.S. Treasuries. There's lots of options for investing in debt. In fact, I'm not sure if you guys know this, but the debt market is immensely larger in size compared to the stock market. The demand for investing in debt is much higher than investing in equities, in stocks. The stock market's big, but the debt market is massive. It's quite a bit bigger. So these are pretty popular sort of investments in general. Investing in debt, in bonds, lending money to companies or the government, in the case of treasuries, is a pretty popular thing to do. So if you have any questions, please ask in the comments. I'd be happy to answer those. And I want to thank everyone for watching, and have a great day.